Someone has correctly said that in investing, what is comfortable is rarely profitable. Hello and welcome back to Exploring Finance with Prashant. I am thrilled to have you here as we continue our exciting journey in the world of financial shenanigans. Until this episode, we have discussed how expenses are manipulated, how earnings are manipulated, how financial tactics are used to manipulate the profits, and how the cash flows are manipulated. In this episode, we are going to discuss the metrics that hide revenue, earnings, or cash flow problems, or simply put, an overly positive spin on modest achievements. Before going on, I want to tell you some basics of analysis which I learned from the book. Whenever we are analyzing a company, we need to first ask two questions. First, what are the best metrics of that specific company's performance? And does management highlight that, ignore, distort, or even make up its own versions of those metrics? Second question, what are the best metrics that would reveal a specific company's deteriorating economic health? And does management highlight, ignore, distort, or even make up its own version of these metrics? To evaluate the economic performance and health of a company or industry, it is very essential to focus on the most relevant metrics, both historical and near term, as long term perspective tends to be unreliable. Let's take a subscription based model as an example. Start by examining traditional performance metrics found on the income statement, such as revenue, operating earnings, net income, earning per share. Also, look at the metrics on the statement of cash flows, including cash flow from operations, free cash flow. These metrics are valuable provided there are no manipulations. However, it is very crucial to go beyond these metrics, essentially in the subscription based business. One vital piece of information often missing from these traditional metrics is the latest developments in business. Are subscriber counts declining in the recent period? Has the revenue generated from each subscriber decreased over the past few quarters? These questions are significant because both accrual based revenue and cash flow from operations reflect past, not the future, revenue or cash flow, whatever it is. To gain a comprehensive understanding, we should be attentive to subscriber based metrics. Information regarding subscriber trends can be exceptionally valuable as it offers insight into a company's current performance and potential challenges or opportunities. Now, sometimes when we look at the important metrics, companies create their substitutes, which they really aren't. In the book, they are called as surrogates. So, there are three surrogates which we are going to discuss. First one is the surrogate of revenue. Management often aims to provide more transparency and insight into their company's sales and future demand. This includes sharing metrics like subscriber counts for cable operators, load factors for airlines, paid clicks for internet portals, revenue per available room for hotels. Now, companies may also create unique metrics we are calling as surrogates, such as same store sales, backlogs, bookings, average revenue per customer, and organic revenue growth to help investors better understand their performance and financial health. These metrics are a broader view beyond traditional financial statements, assisting the investors in making informed decisions. Second one is surrogates of earnings. In an effort to provide a more accurate portrayal of their operational performance, management sometimes opts to present cleaner earnings figure. For instance, a chemical manufacturer might exclude a significant one time gain from the sale of real estate when reporting the earnings. This exclusion helps convey performance in a manner consistent with the past and the future period, facilitating the meaningful comparison. These adjusted earnings metrics, often referred to as non-GAAP earnings surrogates, may carry different name from one company to another. Some Commonly used examples include pro forma earnings, EBITDA, non-GAAP earnings, constant currency earnings, organic earnings growth. These metrics enable a clearer assessment of a company's core operational performance, stripped of exceptional or non-recurring items. Third one is the surrogate of cash flow. Management may seek to present a more refined view of their cash flow, although this can be a bit complex and contentious. For example, a retail chain might report cash flow figures that exclude a significant one time cash payment for a legal settlement. These adjusted cash flow metrics, like their earnings counterpart, aim to provide a clearer picture of the company's financial health by removing the exceptional or non recurring items. Some commonly used cash flow metrics in this context include pro forma cash operating cash flow, non-GAAP operating cash flow, free cash flow, cash earnings, cash revenue, and fund from operations. These metrics help investors assess the core cash generating capability of the business apart from the extraordinary cash events. Now, over with the basics. Let's get on with the techniques that are used to overstate or the performance of the company. First one is highlighting a misleading metric as a surrogate for revenue. Revenue growth is often considered a very vital and straightforward gauge of a business's overall expansion. Companies frequently offer extra data points alongside revenue figures to provide investors with deeper insights into the product demand and the pricing strength. This additional information is generally beneficial, allowing investors to evaluate the sustainability of a company's performance. However, it's essential to recognize that sometimes these non GAAP revenue metrics provided by the management can be misleading, potentially harming the investors. In this section, we explore how companies can be less than transparent when using common revenue surrogates and offer guidance on how vigilant investors can safeguard their interest. Let's go to the first metric of the first technique, same store sales, also known as comparable store sales. It is a very crucial metric for evaluating the performance of retailers and restaurants. Triple S measure the revenue growth of stores that have been open for at least 1 year, providing insights into how well the individual stores are doing, regardless of the company's overall expansion. Now, this is very highly valuable when reported consistently, and there is no universally accepted definition, and the calculation can vary from company to company. Some companies may manipulate triple S by adjusting the base, either by changing the length of time of a store must be open to be included, or by altering the type of stores that are to be included. So we can assess a company's performance by comparing the triple S to the change in revenue per store. If the triple S is growing consistently with the average revenue per store, it's a positive sign. However, a significant divergence between these two metrics can lead issues like new stores struggling or the change in the definition of triple S. Companies may change the definition to manipulate the results, such as I already told you, like adjusting the base, changing something in the base. These changes can create misleading impressions. For example, Coach Inc. modified its base of this formula in 2014 and including store expansions in the triple S calculation, which coincided with a slowdown in the triple S growth as the growth expanded some of its most productive stores. We should pay close attention to which part of the business reported growth reflect, as companies may use subjective distinctions like ongoing business to present a more favorable picture of their performance, even when the objective measures indicate a decline. Thomson Reuters, for instance, reported the revenue growth by considering the ongoing businesses and retroactively recategorized certain businesses to show positive sales growth despite a decline in the objective measures. Let's go to the third metric, ARPU. that is average revenue per user. When we compare a key non-standard metric within a peer group, it's essential to ensure consistency in how these metrics are calculated. For instance, in the broadcast industry, a widely analyzed metric is average revenue per user, computed by dividing the total subscription revenue by the average number of subscribers. Calculating ARPU might seem straightforward, but various definitions of ARPU exist. Let's take the example of the competitors Sirius Satellite Radio Inc. and XM Satellite Radio Holdings Inc. before their merger in 2008. Sirius's ARPU included revenue from subscriptions, advertising, and activation fees. In contrast, XM Radio's ARPU only included revenue from subscriptions, excluding the advertising revenue and activation fees. To make a meaningful apples to apple comparison of ARPU between these two companies, we investors would have had to either adjust the Sirius's ARPU calculation to exclude the advertising revenue and activation fees, or adjust the XM's ARPU by including these sources. It's crucial to be aware of such differences when analyzing and comparing the companies, as these variations can significantly impact the interpretation of the financial metrics. Let's go to the third one: subscriber additions and churn. Going back to a discussion on the subscription based models, such as the research providers, telephone companies, newspapers, fitness clubs, it is very crucial for us to keep an eye on the subscriber level to understand the latest trends in the business. The number of new subscriber addition in each quarter often serves as a leading indicator of future revenue. Likewise, monitoring the rate of cancellations, known as churn, is essential for assessing the business. A healthy subscriber base with increasing new subscribers and decreasing churn typically indicates strong revenue growth on the horizon. A healthy subscriber base with increasing new subscriber and decreasing churn, matlab the decreasing the rate of cancellation, typically indicates a strong revenue growth. However, we must remain vigilant for potential manipulations of these metrics. For instance, in the late 1990s, AOL devised a clever method to inflate its online internet service subscriber number. AOLs would sell bulk subscriptions to corporations, which would then distribute these subscriptions to employees as a benefit. Initially, it did not count these bulk subscription sale in its official subscriber count, as it knew that many of these subscriptions would never be activated. However, when employees did eventually sign up, AOL included them in the subscriber count. In 2001, AOL was struggling to meet its subscriber target. The company started including the number of AOL bulk subscribers sale in its subscriber count, even though most of these subscriptions remained inactive. Furthermore, AOL would ship these bulk subscription membership kits to customers just before the end of the quarter to meet the subscriber count targets. There are other metrics discussed in the book, and I've also discussed some of them on my LinkedIn. You can check up there, or you can read the book for more detailed knowledge. Let's get on with the second technique. Wait, what about the learnings from the first technique? You forgot about that. First, beware of the manipulated metrics. Companies may manipulate metrics like same store sales or ARPU to present a more favorable picture of their performance. Second, consistency matters. When comparing metrics across the companies or periods, they ensure consistency in these metrics are calculated to make accurate assessments. Third, subjective reporting. Companies may use subjective distinctions like ongoing business to present a more positive view of their performance even when the objective metrics suggest something else. Churn and subscriber metrics. Pay close attention to subscriber addition and churn rates, especially in the subscription based business, as these metrics can be manipulated to inflate the subscriber counts. Quarter end manipulations. Be cautious of the companies employing tactics to boost the metric right before the end of the reporting period. Now, let's move to the second technique about surrogate of earnings. Warren Buffett has long poked fun at the management teams that create dishonest pro forma metrics. He memorably compared this practice to an archer who shoots an arrow into a blank canvas and then draw a bull's eye around the implanted arrow. Companies sometimes work their magic to present a more favorable image of their performance. Take the example of Global Crossing back in 2007. They reported a massive net loss of $120 million for a quarter, but were determined to show a profit. They did so by creatively adjusting their figures from adjusted EBITDA to adjusted cash EBITDA less one time items. The catch? They excluded the expenses that shouldn't have been excluded to make it appear as a miraculous turnaround. Speaking of financial gymnastics, let's talk about Spansion, a flash memory manufacturer. They proudly announced EBITDA growth from $61 million to $72 million in one quarter. But the next quarter, things took an interesting turn. They claimed EBITDA grew by $8 million if you excluded a one time real estate gain received in the previous quarter, even though they hadn't excluded it when the reported earnings, uh, came. It's a classic case of having the cake and eating it too in the world of financial metrics. Take another example of Sabre Corporation, a travel technology company, for example. In 2016, they found a clever way to boost their reported EBITDA. They excluded significant upfront payments to the travel agencies, which were meant to entice them to use Sabre's travel reservation system. These payments, totaling $71 million, were capitalized and then amortized over the contract period. While they should have been included in EBITDA, Sabre conveniently left them out. But that's not at all. Some companies go even further by creating their own profitability metrics. Groupon, for instance, got into hot water with the SEC during its 2011 IPO. They were forced to restate their revenues, cutting previously reported figures by over 50%. Additionally, Groupon used a misleading non-GAAP metric called adjusted CSOI to make it appear profitable. This metric excluded various expenses like online marketing, stock based compensation, acquisition related costs. In reality, Groupon had a cumulative GAAP based operating loss of $536 million over 27 months. But they wanted investors to focus on their misleading adjusted CSOI figure, showing a cumulative profit of over $145 million. Now, let's get to the last surrogate, the last technique, surrogate for cash flow. Companies sometimes introduce a pro forma cash flow metric to exclude one time events like hefty litigation settlements. It's a way to present a cleaner picture of their cash flow performance. But here's the twist: there are times when companies aim to boost their cash generation profile artificially using this. Sometimes companies present metrics like cash earnings, cash EBITDA as if they are substitutes for cash flow. But let's be clear, these metrics can be misleading. They often add back non cash expenses like depreciation, but cash flow encompasses much more than that. Consider Global Crossing, a company that wanted to show profit desperately. They started with a net loss of $120 million but managed to turn it into a positive $4 million in what they called the adjusted cash EBITDA less one time items by removing various expenses, some of which were far from one time in nature. This creative accounting made their performance look better than it really was. You do remember that we discussed a part of this example above, right? Another example is Groupon, which also we discussed before. When they faced issues with the revenue restatements, they included a misleading non-GAAP metric, which I already told you, adjusted CSOI. What is the full form? Adjusted Consolidated Segment Reporting Operating Income. By excluding the several significant expenses from their income from operation, they turned the substantial gap based operating losses into apparent profits. Now, here is a new example: IBM, the tech giant. While free cash flow is traditionally calculated as cash flow from operations minus the capital expenditure, IBM decided to redefine it to exclude the changes in the financing receivables. These financing receivables are essentially loans to their own customers, akin to accounts receivable. This maneuver allowed IBM to paint a rosier picture of its cash flow, even when financing to customers created a significant drag on their CFFO. Consider the energy sector, where the master limited partnerships frequently favor the non GAAP metrics. These metrics often influence the investment decisions and the dividend distributions. Take the case of Lin Energy, a Houston based Darling MLP known for its generous dividends. In 2012, Lin Energy paid investors $680 million in dividend, a 15% increase from the previous year. Yet, their free cash flow plummeted to negative $694 million. How could such rich dividends be justified when the company needed to borrow money to fund them? The answer lies in how Lin reported its cash flow, emphasizing on the non standard metric called distributable cash flow. Distributable cash flow had no standardized definition, but for Lin Energy, it is derived from adjusted EBITDA and excluded a significant portion of capital expenditures, creating a more favorable metric that is used to support higher dividends. This financial maneuver raised concerns about the sustainability of the Lin's energy. So, what did we learn from this last technique? First, scrutinize the non GAAP metrics. When an industry relies heavily on the non GAAP metrics, investors should carefully scrutinize these metrics and how they are calculated. Second, assess the sustainability. Evaluate whether companies can sustain the dividend payments and growth, especially when the non standard metrics seem to justify the high payouts despite negative free cash flow. Be skeptical. Don't solely rely on the non standard metrics. In case of Lin Energy, investors who dug deeper into its financials might have avoided the significant losses. The company eventually filed for bankruptcy due to its unsustainable dividend strategy and debt burden. In conclusion, I want to say that management may create surrogates for revenue, for earnings, for cash flow, or trying to obscure the true financial health of their companies. Astute investors, such as you and me, must question the authenticity of the financial metrics and remain vigilant. Beware of the misleading surrogates for revenue, earnings, and cash flow, and scrutinize the non standard metrics with a critical eye. Assess the sustainability of dividend payments and growth, and always look beyond the surface to understand a company's true financial picture. Thanks for listening to this episode. In the next episode, we move from examining metrics that paint an excessively positive picture of a company's performance to metrics that obscure the warning signs of potential balance sheet deterioration and economic health problems. Until then, keep questioning, keep learning, and keep exploring the captivating world of finance. Thank you and have a nice day.